Yeah, I'm losing my
It's time to roll futures here, Pete. We are going to
take a
get
shot
after it. The most fun time of the month here is to roll your futures. We're going to look at small exchange futures. We're rolling from March into April. That is the next month here. The weather's getting warmer here in North America. It's very nice, and you want to extend the duration in your futures. And it's something that hopefully will make it so easy that if you wanted to, you could do drunk. We'll figure it out. To enjoy the exclusive capital efficiency that futures pose, Pete, they must expire and fulfill their name's calling. You know, it's one of these things where futures at the small exchange specifically, a new futures contract sprouts up every month. Okay. The third Friday, there's an expiration. And guess what? On that Monday following, there is a new futures contract that sprouts up. And it's almost like a phoenix rising from the ashes of the last futures contract, but it must at some point return from whence it came and expire. And so what we're seeing right now is those March futures that sprouted up in mid-January, Pete, they are now expiring here on the third Friday of the month of March. And thus, you must change those March futures into April futures. And you've got a lot of letters here that coincide with the different months. At the small exchange currently, we have an expiration for every month. So when the third Friday comes up, right now it's the Wednesday before that Friday, a perfect time as any to roll your futures. Pete, you just need to switch this H here in March to a J, right? Not so difficult, enough. Right?
No, it's just, again, we're just rolling. You're just rolling your exposure. This is truly housekeeping. All we want to do is maintain our exposure. Good news with cash settled futures. I'm sure Frankie's going to hit on this. If you do nothing, they just go away. What I mean by that is they just come off the board. They'll expire at 3:00 on Friday, and you'll get a realized debit or credit in your account, which is where your position was established against the expiration value. So, I mean, do you have to do something? I like to stay where it's liquid. I like to be able to roll into the active month. April is becoming that active month today. So we like to be where the liquidity is so we can find opportunity and manage it. So it's as simple as that for me.
Yeah. And I want to do, the question always becomes like, well, why do I have to do this house cleaning at all? Why can't you guys create futures that not only look and feel like ETFs in terms of the pricing convention that we have at the small exchange? Everything ticks in pennies, and everything is just $100 multiplier. It feels like just 100 shares of ETFs. People are always like, well, why can't I just buy it or sell it like an ETF, enjoy the capital efficiency that futures provide, a fraction of the cost of those ETF shares, and just have it live on forever? And that is something that we have not yet solved, because that wouldn't be a future at that point, right? Like this product type was created, and it gives you that the leverage runs in tandem with the fact that it is a future, right, Pete? Maybe you can illuminate that a little bit.
And you know what? You're spot on. So it's like, well, why? Right. Why don't I get this? I get this benefit. And you're spot on. But in the name, this contract. Now, when you buy an ETF, you have an obligation. You own it. Either you pay full freight for it or you buy it on margin. There is ownership the minute you buy that. Now, a futures contract gives you the right, but not the obligation to participate in this market up to the delivery point. Now, none of us go through delivery, but because it's a contract you're trading for a future point in time and not an implied ownership of the underlying, you then can look at this contract and margin it. So that is the nuanced difference of why these pieces are delineated in the future, because it was like, well, just give me crude that is spot every day, or just trades front month every day. The creation of the product and the affordability of the margin is by its structure. And that structure gives you the fact that, I'm not articulating this perfectly.
Well, it's almost
the structure gives you the fact that the contract at some point has to expire. If it has to expire, that means then we have to do something. So that's the trade-off. We get all the benefits of the leverage and the efficiency. This is the trade-off, and it's just in the nature of the way derivative structured products are created.
Yeah, and it's almost like, I don't think it's technically a catch-22, but it's similar to a catch-22, whereby it's like, oh, I want the efficiency of the futures as opposed to buying the basket of stocks or buying gold or buying, a currency contract that can be very large. Whatever the future is on, it's like, yeah, I want that efficiency. And then it's like, and I also don't want it to expire. And it's like, well, I can't get you the efficiency unless the thing expires. And it's like this debate that we see sometimes on Twitter and everywhere else. And I can appreciate the frustration, because rolling, though it takes all of 10 seconds, it is a pain in the butt. That being said, I can't give you the efficiency without making it expire, and thus you have to roll. Otherwise, you don't get the efficiency. You see what I'm saying? I think it's a catch-22. I don't know. Kurt Vonnegut's going to get mad at me one way or the other. But yeah, how do you roll, Pete? And this was something that I totally feel for. A viewer of ours tweeted, you guys got to talk about the roll, because I accidentally just covered my long S2Y position, and I didn't have time. I didn't immediately buy S2Y in April after closing my long in March, and the market moved up by 10 cents or 20 cents, and that's called legging risk. Now, Pete, right. We don't run platforms. We run an exchange over here at the Small Exchange. So we can't necessarily get in there and show you on your platform how you roll. But Pete, most platforms have a roll function whereby, or at least a spread trading function, whereby if I'm long SM75 or S10Y, or like our viewer was long S2Y, H21, the March contract, I should be able to, in one fell swoop, one single trade, sell the H21 and buy the J21 without, like our viewer, and I feel for him, without missing that side, without taking on that legging risk, right?
Yeah, absolutely. And that's, you know what, again, that's why these roll markets exist is, and I mean, I did a career of legging spreads in the pit, and it was a lucrative way to trade and gain edge. But what we want to do right now is, again, housekeeping means this is not, when we build a trade and we have a strategy on bias and we set up mechanics, those mechanics aren't, oh, well, this happens, my strategy carries me over a roll period or an expiration, so I'm going to get clever and do one leg and then wait to see if I can get the other leg done. That wasn't the strategy, so that's why we just roll these and get, this piece is not part of the strategy, so we just want to extend duration to keep the management of our idea consistent.
Absolutely. And the last piece here, before you get on to your Guinnesses and your Jamesons and your...
I can only imagine what your grade school was like with you guys smuggling in all that liquor. Jeez Louise.
I didn't...
St. Barnabas, was that it?
I was a late bloomer. I didn't start drinking
until you're 12, 13. I know.
15, 16. But yeah, what is your favorite? Pete doesn't drink so much anymore, but what do you remember a good Irish beer? Did you like, I think Harp was one that was popular. Was that? You didn't care about that. You were more like a boot of beer. You were like a German kind of like
I would like
Oktoberfest guy.
Yes, absolutely, a dark, heavier ale.
I can see that.
Yeah,
but yeah,
like
I always
the boot.
Yeah. But either way, we'll let you get to your boots and your pints and everything else, because if you do get too inebriated to cover your futures, the nice thing is the worst case scenario at the Small Exchange, they settle to cash. What does that mean? If you were long S2Y or SM75 or whatever, and you take it through Friday expiration, your account just gets debited or credited the amount that you lost or made on that trade, whether you were long or short, the market went for or against you. And on Monday, the worst case scenario is you don't have that exposure anymore. So if you do miss the expiration and rolling, we absolutely advocate for rolling prior to expiration. But worst case scenario, the Small Exchange futures settle to cash, and on Monday or Tuesday or whenever you wake from your hangover there, you can get your position back on then. No worries.